Question number 2, frequently asked question. How do I avoid capital gains tax when selling my business? Get that one a ton.
Yeah, I mean, being in exit planning, we get that a lot. It's the question of, I want to exit. I'm tired of doing the business. I'm exhausted. I've been doing this for 30 years. I've been doing this for 20 years or 40 years, whatever. I don't want to pay the tax. Okay. Well, there's plans to do that. You can work with the buyer that is buying the business. You could do an installment sale, right? An owner finance. There's some risk there to do that.
Yeah.
What if they don't pay? What if they're not doing the business like you are? You could stretch out the capital gains over 10 or 20 or 30 years, right? If you wanted to do that. That's one way. You could also have another tax strategy to help offset the tax. So let's say you turn around, you sell the business, turn around and buy some more real estate and do a cost segregation study that helps offset some of that income. Well, now you've offset your capital gains, right? You could do charitable gift planning. We have a lot of charitable givers that are like, hey, I'm doing great, Brian. You know what? We're giving money away because we don't need all this money. We're worth $7 million, $10 million, or whatever. We don't need all of this. So let's do a charitable lead trust, right? And instead of you giving it from your checking account, we'll help offset some of the capital gains. And you don't change your cash flow. You're not giving more money away. You're just doing the same amount, right? So nothing's really changed except we're setting up a trust, writing off the check, and we're helping offset. It doesn't actually have to be related with the business sale, right? You could be doing what's called post-sale strategies after the fact. So it doesn't always have to be, well, we're doing this charitable trust and you're putting the assets of the company in the charitable trust before you accept an offer. That's pre-sale, which most people call us like 2 weeks before and say, hey, Brian, what can you do?
Right.
Well, the 3 best strategies are gone.
Yeah.
One of them we use for folks when they have time and they have a charitable intent. We had a couple years ago that had no kids. Their nieces and nephews were just not close to them across the country. They really were just going to leave it all to their colleges anyways, eventually. They had it in their will. I read their will. I said,
wow.
Okay, so you're going to give it all to the colleges. Okay. I mean, it was a substantial amount of money. And they had this business they were going to sell. The capital gain on it was somewhere in the neighborhood of $800,000. And I said, well, why don't you do a charitable trust, a form of one? Pooled income funds is one where you can still get the income for the rest of your life, and the colleges get it, but we get a massive tax deduction, and you don't pay any tax, 0. You know what 0 is?
It's less than 800,000, I'm guessing.
Yeah. And so people are like, okay, but there's a lot of disadvantages to it. Yeah, it's not a perfect fit for everyone. I get that. And sometimes if you had asked a family, let's say they had family they wanted to give it to, right? Let's say they wanted it to go to kids or whatever. Well, we can set up a wealth replacement trust to make sure that the kids are taken care of. But in this situation, they didn't need that. It was simple. Well, you're already giving it away to the college. You're not getting any benefits when they get it. Let's get the benefit now.
Yeah.
No tax. And then they got a large charitable deduction. And a pooled income fund is very similar in some ways to a charitable remainder trust. Every tax attorney out there has heard of a charitable remainder trust. It's been around since 1960s. Nothing new. Pooled income funds has been around that long too. But the difference is you can control the investments in a pooled income fund and you get a larger charitable deduction if you're younger. So they were younger. They were in their 50s. We're able to convert most of their IRAs for no tax. So they get tax-free income in retirement on top of that, which benefits them. The charity still gets everything. But the biggest loser is the IRS. And the Virginia Department of Taxation.
Shucks.
I know. They were very disappointed too.
Aw,
Yeah.
I'm sorry, Uncle Sam. Dang.
So that there's a lot of ways. It's not as easy as like, oh, we have one tool in the toolbox we're going to pull out. I mean, there's hundreds of different ways to help minimize it, defer it, or eliminate it.